Well, welcome to our High Rock monthly video for March. I'm Scott Tomlinson, and with me on the call today is Paul Tepsich, who is the founder of High Rock and the portfolio manager. So we're going to just talk quickly about February. January was a pretty significant up month for most assets, and February saw bit of a pullback in most of those same assets. Interestingly, while stocks and bonds pulled back significantly more, balanced assets actually sort of held their own a little bit. So, Paul, I don't know if you have any comments on any of this, but basically more corrective activity from a pretty strong January, I would say.
Yeah, one comment. The market giveth in January and the market taketh in February, but didn't take back as much as it gave us in January, thankfully. And gold and silver seems to be the standout. I think a lot of that being driven by the US dollar bouncing somewhat higher across the month. So arguably hurt all US dollar assets, but certainly gold and silver the most.
Excellent. Okay, so we can be pretty quick and brief. As we tend to do monthly, we show the iShares Core Balanced ETF, which we use as one of our benchmarks, just to give us an idea of how other balanced assets are performing. And it was down about 1.5 total return on the month. Year to date, it's up about 3.5. So that just is, again, just a snapshot of what we were just talking about, basically. Anything you want to talk about with regards to any of the special mandates, the high yield, Paul?
Not really. It was actually a pretty quiet month in the space. Again, like other risk assets, those that went up in January kind of came off a little bit in February, but I must say that the performance was reasonably flat across the month of February. And really, quite frankly, because of the significant interest income that those portfolios drive. So although prices maybe came off a snick due to rising government bond yields, it really wasn't all that substantial, not enough to put negative performance into the portfolios.
Excellent, excellent. We are always focused on the long term, of course, and it's important that when you have questions about your particular strategy, that you get in touch with us so that we can update it. We do send out quarterly reports, and in those quarterly reports, when I send them out, I do ask you to get in touch to have a portfolio review. Some of you take that to heart, others let it go, but I have always time in my schedule to be able to talk to anybody about their portfolio and their strategy, so please don't hesitate to get in touch. One of the things that we've been monitoring on a regular basis is inflation. The CPI, Consumer Price Index, is one of those measures. There are a number of measures of inflation, but the CPI, total CPI, is something that we have been following. And as for the upcoming numbers, February CPI for the US will be released on March the 14th. The expectation is for a 6.2% annualized increase. And in Canada, that announcement for February will be on March the 21st. So these are things we keep an eye on. They are things that the markets are watching closely. All inflation numbers are. And if they are higher than expected, then we could expect markets to churn down, and if they are lower than expected, that is probably a bit of a buying signal for short-term markets anyways. Paul, I don't know if you have any comments.
No, nothing to add, Scott. Well, obviously, I guess the one thing to add is inflation. The reason why you have the screen up and talked about it is inflation is what's driving the central banks, or has been driving the central banks, certainly in the US, to jack up rates at unprecedented rate or level. Bank of Canada, as we can see here on this slide 9, has told us they are effectively finished hiking rates, but subject to incoming data. So we shall see. But inflation is the number one thing to be looking at, and some of the other inputs that drive inflation.
And interestingly, I think we can bring attention to the fact that in the US, it seems to be that it's taking a little longer for the Federal Reserve to get inflation moving down as quickly as it seems to have moved down in Canada. And by virtue of that, there is a bit of an expectation of, or I'll say a higher probability than the last time we talked, of a 0.5% increase at the next FOMC meeting on March the 22nd. The greater probability is for still a quarter-point increase, and then again, as you said, data-driven and beyond that. But it's interesting that the inflation numbers are taking a little longer to come down in the U.S. As opposed to in Canada.
And one thing I would add too, Scott, is there are a couple macroeconomic economic firms that are saying that the Fed is looking at lagging and coincident economic indicators, and not so much at the leading indicators, and feel like they're jacking up rates here at the end of the cycle into a policy error, which means, quite frankly, that could possibly tip us into a recession. So we'll see what they do.
Yeah, we're keeping an eye on all of that, and of course, it certainly impacts our strategies as we go forward. If and when global equities pull back, as they could well do in a recession, we'll have a look and look for some buying opportunities there. Until then, though, we're sitting pretty tight, close to the vest with what we've got.
And one thing, Scott, we did have quite a few new clients come in over the past month or so. So on the global equity model, those new clients, we have been investing some over the past month, buying a little bit of weakness where we can, and just getting them a little bit closer to being invested. So those folks will see some buying activity in the global equity model.
Yeah, and it is, we do talk in generalities, but again, when it comes to client-specific situations, obviously we're tailoring our strategies to those specific clients, especially the newer clients who are coming in. Yes.
Tactical models, there was really only one trade. We sold our entire position in Ensign Drilling, which is a natural gas and oil driller, and part of the theory behind that was, number one, that bond now has less than 1 year to maturity. It's still a pretty big net for the company to refinance. Now, it did pay us a very hefty yield, so that has been removed from our portfolio for now. But the second part of the reasoning was natural gas has really been hammered here. Even again this morning, as we speak on Monday, March 6th, it's off almost 15% on the day. That's just the effect of really warm weather. Natural gas is a very geographically centered commodity, i.e. North America. So I'm a little bit worried that drill rigs might actually get cut as we move forward. So anyway, the company just reported last week. I'm just going through their numbers this morning. So it's not a bond that we dislike necessarily, and it's a bond we might look to rebuy if we can find a better buy-in point. That's it for the tactical model. Fixed income, we did add to our 30-year Government of Canada position earlier in February. And on the preferred share side, we're about 60% now in fixed rate preferred shares and about 40% in floating rate. We'll probably kind of hold that, but we will still gravitate, as we feel like inflation has peaked and rates have peaked, we'll gravitate more into fixed rate preferreds. But we're, we're a bit more balanced now with that, with our positioning. That's it.
Excellent, excellent. On the administrative front, it is tax time, and we just want to make sure that everybody is aware that they do have the ability to get access through the Raymond James site. If you don't have access and you want to set up access, it's important that you get in touch with us so we can do that for you. But from a tax documentation perspective, there is lots of information for you there in the My Documents section. Under tax documents, there's a client guide to tax reporting, information about T3s, tax receipt schedule, and things about US tax receipts. So a lot of information, and it's important that you have access to this information before you file your taxes. And obviously you want to make sure you're getting your receipts. Even on the home page, there's a reminder right off the bat that you can click to see what the tax receipt schedule is, to make sure that you know the dates when to expect certain receipts. The one that everybody, or not everybody, but a lot of people tend to forget about in their anxiousness to get their taxes filed is the T3 Canadian Trust Income that is not scheduled to be mailed until March 31st. So don't file your taxes prior to that, receiving those is my advice, because you'll just have to refile if you get documentation after the fact. Now, anybody who wants more assistance, we are here and available. Diane, myself, please don't hesitate to give us a call or send us an email if you want to get access to the Raymond James site if you don't have it or you lost your password or whatever. Anyway, we are standing by to help. And that is it for the month of March. Thanks, Paul. And on behalf of Diane, thank you to our clients for taking the time to listen. And we shall be back next month with another version of our monthly video. And until then, please take care.